Welcome to the tutorial for Module 8, Mergers, Acquisitions, and Joint Ventures. This begins on page 20 in your course presentation and concludes on page 61. I've worked in this field for many years, and this is of course a topic that I'm very familiar with and would like to share some of my experiences with you. I'm not going to cover all the slides, but I want to cover the issues that I feel that are important. Mergers, acquisitions, and joint ventures are frequently used as a way to grow a business. And that's the reason why I included here under the title Corporate Growth and Development. If we take a look at the strategic objectives of the firm, one of the objectives of the firm is to grow, because businesses that don't grow typically end up being acquired by other businesses or simply liquidated over time. And corporate growth and development is a key strategic objective then of management. And here you see that this is in the context of various issues. In other words, how do we grow our businesses? As I mentioned, I think in an earlier module, we have growth opportunities that we can either grow the business then internally through research and development, in other words, investing in our own products and ideas internally, or organic growth, or we have the opportunity of growing through acquisitions or merging businesses then with other businesses. We do this with the objective of trying to grow our sales either in the form of having new products, developing new products, or acquiring new products, or trying to achieve market access then by our own measures. In other words, trying to create sales and marketing organizations to sell our products in domestic and international markets. And by doing this, we can either think about investing internally, or we can think about trying to buy companies that meet our strategic objectives. If we take a look at some of the strategic objectives, one could be globalization. In other words, taking our businesses, making our business more international. I live and work in Germany, a country in which the market opportunities for companies become exhausted fairly early, which means that companies have to go out and seek opportunities outside of Germany to find ways of growing their business. And oftentimes the companies discover that after a fairly short period of time, the growth opportunities in the domestic market are exhausted, so they begin taking a look at, first of all, investment opportunities in countries that are immediately surrounding Germany, for example. It could be France, or maybe going farther south to Italy, then maybe to the UK, and then farther, for example, North America, or then the Far East, and so forth. All of this requires either investment in your own sales and marketing organization, or looking to acquire companies that will provide you then access to those markets. A company may want to do it on its own, but it could also possibly consider using joint ventures as a means of achieving that objective and reducing the business risk at the same time. And here we see strategic alliances. In other words, companies that partner together with foreign firms, so that leveraging on the knowledge of the foreign firm and then having them committed to the investment as an investor, and at some point in time, if the venture works out, then acquiring then their foreign partners' shares and then becoming a 100% wholly owned subsidiary. Other things that are important then to firms that are seeking growth are, of course, the financing, and we've been talking about that. But other things like, for example, the issue of corporate succession is also a key issue, particularly in the generational transition process, as business owners, for example, reach retirement age, looking for other people that may be interested in acquiring their business if there's no one in the company, or perhaps a member of the family that's willing to acquire the business. For larger firms, the issue of concentration on core businesses is also key. As we discover over time, and this is also an issue in your class simulation exercise, large companies in good times buy a lot of businesses, and then in bad times sell the ones that don't achieve the returns that they expected. Either there's an issue with management. In other words, they end up acquiring companies that they really didn't understand, and they didn't have the patience, for example, or the desire to try to build up a management team that's capable of running the business, possibly because it doesn't fit their core strategy anymore, and therefore we see businesses selling those kind of businesses. And finally, up here, the issue of financing corporate growth is always key, because anytime you acquire a business, The question is, if you don't have enough of your own funds in the company, then you have to go outside of the company and look for the money to acquire the companies. On page 22, you see the historical development of mergers and acquisitions. And I think the most profound change, if we go back and take a look at about a 50-year history, is the fact that the type of transactions that we see today have a much stronger strategic component than they did in the past. If you go back 50 years ago and you see the term conglomerate mergers and acquisitions, that was a period in time where companies would essentially buy a portfolio of businesses and run them essentially like a fund manager would run a fund. In other words, the corporate management was paid to go out, buy businesses that presumably would achieve some kind of overall return, and then at that point in time then run them as conglomerate holding companies. These companies may be involved in various different, or may have investments in 8 different companies in 8 different industries, each having their own different perspectives then in the economic cycle. And as a result, there will be some overall return. Today, things have changed. As we progress to the present, we see more what I call horizontal and vertical mergers and acquisitions. There's a stronger strategic component. In other words, it's not just to go out and buy businesses to put them into a fund, because presumably investors can do that on their own, but to go out and find businesses that the corporate management is capable of, first of all, understanding and then running successfully. In the interim, in the 80s, a lot of the transactions were financially motivated. In other words, the issue was the cost of borrowing was low, the availability of funding was high, and the idea was to go out and try to use as much of other people's money, in particular bank loans, to buy other businesses, and then by achieving that higher level of financial leverage, with this financial engineering, optimizing returns then to the equity investor, in other words, their return on investment. If we go down this list here, we see some of the motivations. In the 60s, largely risk diversification. This was when there was a lot of talk about portfolio theory that came out of different from different business schools, the idea of a diversified portfolio to reduce risk. In the 80s, the talk was of recapitalization. In other words, how can I shift my debt and equity focus, using more debt that's tax deductible to achieve a higher return on the equity, meaning we have a higher level of financial leverage. And today we're talking more about growth and value enhancement, and those are the issues that we look at. In terms of financing, in the 60s and 70s, the financing was largely with equity. These holding companies were oftentimes listed on the stock exchange. They would simply issue new shares in the public market and achieve cash proceeds through the new share issue, and then use that cash then to go out and buy other companies with. In the 80s, most of the money and funding was coming from bank debts, and this, you would see oftentimes leverage that would go all the way up to 3 times debt to equity at 3 times or greater, and that means that we have a large amount of bank debt or bonds that were used to finance deals. Today, we see more equity type of deals. In other words, companies are using their own shares as acquisition currency to go out and buy other businesses. They're simply swapping their shares for the shares of the target company. The advantage of doing that is that the former shareholders then become engaged in the business as it moves forward, because they're not receiving cash. There's not a clear transfer of wealth here in this particular case, because the former shareholders now receive shares of the acquirer and then share, of course, the risk with the acquirer that the business in the future will succeed and thrive.